let's start accounting standard 2. Valuation of inventories. This AS is mandatory without any exemption to any kind of entity, whether non-SMC, SMC, level 3, level 2, etc. This AS is not applicable on inventory of shares, debentures, bonds, natural produce, for example farmers produce, mines, ores, etc. Inventory means held for sale, held for consumption, held for sale in ordinary course of business, held for consumption in production of goods or rendering of services. I'll just talk about two concepts. If any asset is held for sale, it is inventory. Held for use in production oblique rendering services, then it is a fixed asset. If it is held for consumption, then too it is inventory. So there is a very thin line difference. Held for use, held for consumption. Use in what? Use in production and rendering of service, then it will be fixed asset. Otherwise inventory. If it is meant for consumption, that will be raw material. Alright. If it is held for sale, then you can be the person can be a trader and he sells in finished goods. Alright. So let's see further. Inventory means assets held for sale in accordance with in ordinary course of business, held for consumption in production of goods or rendering of services. Valuation of inventory. Finished goods or work in progress is always valued at cost or NRV, whichever is lower. Alright. How to find out cost, we'll discuss it later on, and how to find NRV, we'll also see it later on. Alright. And only one kind of inventory is left, raw material. Always valued at cost price only. Alright. However, if finished goods in which that raw material is used is expected to be sold at price less than cost, then raw material is valued at cost or replacement price, whichever is lower. Generally the replacement price will be lower. Alright. Now, cost price of inventory. How to find out cost of finished product or any other thing? That can be divided into three methods: actual cost method, standard cost, alright, and then one is gross profit method, or retail price minus gross profit. We'll discuss this in the summary portion. I have made a chart of AS2. There it is discussed very neatly. Alright. The details are over here. Actual cost. Actual cost incurred to bring the raw material to its present location. The finished goods or raw material or whatever it is. Alright. Let's see. Raw material, purchase price, taxes on purchase which are not refundable. If taxes are refundable, it will be deducted. For example, excise duty. When Senmet credit is available for excise duty. Expenses to bring stock at present location. Total purchase cost. Now cost of conversion of raw material into finished product. Direct labor cost, variable overhead, fixed production overheads. Now fixed production overheads will be either on normal production or on actual production, whichever will be higher. Fixed cost into units in stock. Total cost. This will be the method of actual cost. Actually, you don't need to actually mug up all this thing. When we will be discussing the question and answers, you'll be able to answer all these things by yourself. Actual cost does not include. This is very important. General administration overheads, selling and distribution cost, abnormal loss cost, borrowing cost unless stock is a qualifying asset as per AS 16. Abnormal cost. We'll see this point when we will be doing accounting standard 16. Abnormal cost, total cost incurred divided by normal units, or we can say input minus normal loss units divided into abnormal loss units. Alright. Now standard cost means per unit calculated for the purpose of application of variance analysis. This cost should be taken for the purpose of stock if actual cost approximates to standard cost. This method is least used, and you will not see even a single question in the whole practice manual as well as in any of the leading author's book. So this is just theoretical. Under retail price method, one is retail price method. The stock is valued at retail price less gross profit included in the price. This method is applied in if gross profit ratio is constant. Again, this is very theoretical method. You will not find any question related to this method, which this is a question of IPCC level. Alright, next question. Treatment of joint and byproducts. This is important. We'll see questions in practice manual for this specific portion. Sale proceeds of byproduct should be deducted from the joint cost. Joint cost should be allocated to each product at split off point in the ratio of sale value. The most important line is this. I'll just highlight it for you. Joint cost allocated a ratio of sale value. Alright, we'll see question answers. Then you should not mug up all these things, but you should just use your common sense and just memorize all those points which I mark as highlighted. Alright, and one is what is NRV? Now let me just show you the chart, then you will be able to actually see that how inventory is valued. Valuation of inventory. One can be raw material, either it can be raw material or it can be finished goods or the work in progress. Valued at cost or NRV, whichever is less. For calculation of cost, we had three methods: actual, standard, or this was retail price method, or marginal retail price method, or NRV method. Now how to compute NRV means estimated sale price minus estimate selling expenses. This is NRV, very simple. Estimated sale price minus estimate selling expenses and cost of completion. This is also, you can say, selling expenses, etc. This is NRV. NRV be based on actual sale price if goods are sold before approval of accounts. If entity has entered into contract for sale, such contract will be used in NRV. Alright. Last point in this is disclosure requirements. Inventory valuation policy should be disclosed. Cost method adopted, FIFO, weighted average, LIFO should be disclosed. This completes accounting standard 2. Alright. All the notes are provided in the description below, and for checking out practice manual you should just hit the link. You should just open BOS knowledge portal, and then you'll be able to, you should select final course, and then old or new as may be applicable to you. Whatever we are doing, it is both applicable to new as well as old or new. Then your FR, and then the study material and everything will be in front of you. You just have to click it. Now we'll be discussing practice manual. Financial reporting practice manual final course. There are few theory questions. I have just highlighted the important portion and we'll be discussing the crux. Alright, so let's see. A private limited company manufactures fancy terry towels. Valued its closing inventory of finished goods at realizable value. Now, what are finished goods valued? How are finished goods valued? NRV or cost? Lower. Alright. Inclusive of profit and export cash incentive. Firm contract have been received and goods were packed for export, but the ownership of these goods have not been transferred to the foreign buyer. Comment on valuation of inventories. Now they are saying inventory is valued at inclusive of profit, export benefit. Alright, and goods are only ownership is pending to be transferred, and means this is not just AS2 question, it includes provisions of AS9 as well. Let's see the answer. Inventory should be valued at lower of historical cost or NRV. As per AS9, revenue recognition states at certain stages, specific industries, when agriculture crops have been harvested, very important, agriculture crops and mineral ore have been extracted, performance may be sustainably completed. Performance may be sustainably complete prior to execution of transaction of generating revenue. In such a case, sale is assured when sale is assured under forward contract or government guarantee, when market exists and there is negligible risk of failure to sell. The goods invoice are often valued at NRV. Now this NRV may include the profit element as well, but these goods are not, neither these are crops, neither these are mine ores, mineral ores. So this must be valued at something in some different criteria. Let's see. Towels do not fall in the category of agriculture crops or mineral ores. Closing inventory of finished goods should have been valued at lower of cost or NRV, not net realizable value. Export incentives are recorded only in the year an export sale takes place. Hence, policy adopted by the company for valuing its closing inventory for inventories of finished goods is not correct. Pretty simple. A raw material purchased at 400 per kg. Company do not sell raw material but uses it as in production of finished goods. Finished goods in which raw material is used expected to be sold for below at cost. Company is having 10,000 kg of raw material in its inventory and the replacement cost of raw material is 300. Now if raw material is always valued at cost, but if the finished good is expected to be sold below the cost, and then it should be valued at replacement cost, raw material, only exception. Let's see the answer. Material and other supplies held for the use in production are not written down below cost if the finished product in which they are incorporated are expected to be sold above the cost. Alright. Therefore, replacement cost of materials may be best available measure to NRV. Therefore,